The Bank of Canada has delivered another 50 basis point rate cut in its last rate decision of the year, and it's signaling it may take a more gradual approach in 2025. Joining us now to discuss, Andrew Kelvin, head of Canadian and Global Rate Strategy with TD Securities. Andrew, always great to have you here, especially on the Bank of Canada Day.
Thank you for having me.
This was an interesting one. 50 basis points, I think, was the expectation from the street and your shop. The shift, though, in the language as to what they might do next, a bit of a surprise.
A bit of surprise. There's always a little bit of intrigue with these announcements. It's never just the number, then they go away. There's always a lot of text around it. They do a press conference after every announcement as well. And I think you're right. The interesting thing was the indication that the pace of easing going forward would be likely a bit more gradual if the economy evolves as they expect. It's always going to be with a caveat that it's contingent on their forecast. And it's a bit of a strange one for me to sort of interpret it, because on one hand, our expectation was that they would slow the pace of rate cuts after this meeting. Like, we were looking for the 50 basis point cut today, and then we expected them to slow to 25 basis point increments starting in January. So when they say that a more gradual pace of easing is likely appropriate, like, I agree. We had been in restrictive territory. We are no longer obviously in restrictive territory, so it's prudent to move a bit more slowly. I think what was interesting about this is that they were so explicit in providing that guidance to the street. They have from time to time in recent years come out and tried to be very explicit in their guidance. Most famously or infamously, when the governor said that his message to Canadians was that rates would be low for a very long time, and it was perhaps not as long as they expected. So I was a little surprised to see them come out and provide that degree of clarity to the market, even if I do agree with the assessment. And I think the question is, the fact that they're comfortable providing that clarity, does that imply that there's a very high bar to jumbo rate cuts? And does that imply that we're maybe a little bit closer to the end of this easing cycle than certainly I expect? We think the Bank of Canada will end this easing cycle at 2.25%. They're at 3.25% today. But it has raised some questions that if they're willing to provide that degree of clarity, that they're willing to slow down here, perhaps they're not, they don't have four more rate cuts in the chamber, as it were.
Let's talk about the impetus behind. It was another jumbo, it was another 50. What were they seeing in the economy that they felt, okay, this is what is necessary now in terms of the cost of money in this country?
It was twofold, and it is great. It is a jumbo, and the idea of a hawkish 50 basis point cut is.
When I first look at the bond market reaction, I'm like, okay, I'll think through this, but at first blush, I'm not getting this.
It's a bit of a contradiction in terms. And when we were discussing the risks, someone asked about the risk of a hawkish 50, and we all just kind of sat there and thought, hawkish 50 is that's a combination of words that doesn't make sense, but here we are. So the big piece of it for the Bank of Canada, and they said this in the press conference, the governor said in the press conference, is that they see the neutral rate as between 2.25% and 3.25%. They're slacking the economy. Inflation's at 2% and expected to remain around 2%. That is not a state of the economy that requires restrictive monetary policy. So what they said in the press conference is they no longer felt restrictive monetary policy was warranted. So what they were doing, I think this is the way you read October as well, is they were just rushing to get to the neutral, somewhere close to the neutral rate. You can never know precisely where it is. It's unobservable, but they think it's between 2.25% and 3.25%. Well, we're at the top of that range now. So I think the right interpretation is that they were rushing to get back to something close to neutral, because the one thing they believe they know with a high degree of certainty is that you don't need to be restrictive with this sort of unemployment rate, with this sort of inflation. The other thing they discussed was, and again, I agree with them on this as well, the data we've had since October has been a little bit on the weaker side. Q3 growth was a little bit below where they anticipated it to be in their last forecast, and the early indications on Q4 are likely to fall short of their 2% annualized GDP forecasts. The governor did make mention of the fact that we are going to be seeing a little bit less growth next year in all likelihood due to the slowdown in population growth due to recently announced federal government migration targets. So you put all that together, you already were of the view that you didn't need to be restrictive. And you've had a few downside surprises, so it warrants a 50. Certainly more so than October did. So to flip that around, if October warranted a 50, certainly December did. That rebound in core inflation that there had been some focus on at the last CPI print, I think that was something that was entirely foreseeable. That's something that I think they had expected, and I don't think it's something that worried them at all.
So last decision of the year, last time we're going to hear from him for the year and around some of these issues. I know he gives one more press conference before the end of the year, but so we'll get some thoughts there. But pretty clear indications as to what they think might be some of the things on their radar for 2025. In that statement, you mentioned the immigration policy changes here domestically. And of course, President-elect Trump takes the White House in January, tariff threats. There's a lot in the mix. How are you seeing it?
So we had cursory sort of mentions of all these things. In the statement, they talked about that the threats of tariffs from the United States were clouding the outlook, producing heightened uncertainty. The Bank of Canada can't make policy on potential U.S. trade policy changes. A one-off social media post and a few headlines and a few taunts to follow from the president-elect. Which is the perfect time to be making taunts because you can't follow through, so you don't need to worry about following through. That's not the basis for changing a monetary policy path because these things can reverse themselves in the blink of an eye. Clearly, it would be very disruptive if you receive significant tariffs. It's clearly something they're watching. There's a lot of modeling that will need to go into it, and it also will depend, are there carve-outs for these sorts of tariffs? If you think about Canada-U.S. trade, our trade with the U.S., while we do have a large surplus of the U.S., that's an energy story. If the United States does not want to see energy prices increase domestically, which is generally not politically a well-received thing, you would have a carve-out on energy, and that's the biggest chunk of our exports to the U.S. Does Canada retaliate? We have heard indications that if there were to be a tariff spat, you would see retaliation from the Canadian government. That has impacts for inflation. And I guess where I'm getting at, this is this branching sort of series of conditional outcomes. You only need to go a few sort of what ifs down the road before you're talking about just such a high degree of uncertainty. You can't really plan for it. The Bank of Canada did suggest that the uncertainty is probably already impacting business investment decisions, and that's only sensible. If you don't know what your market access to the U.S. is going to be, perhaps you want to hold off in making investment decisions. So they are thinking about these things as already having probably negative impacts on growth, even if they're not actually in place. But it really is something they will just have to react to.
We take all of this, we put it together. We talked about the bond market reaction as well. What do we need to keep top of mind heading into a new year when it comes to our economy, when it comes to the cost of borrowing?
So the Bank of Canada is an inflation target. So I think that's first and foremost. If inflation remains around 2%, they can continue to ease. The way they think about the inflation generation process is that has to do with the amount of slack in the economy. So you've got that last jobs number, the unemployment rate rose to 6.8%. There were some participation rate changes in there which drove it, but at the end of the day, we are in a position of having slack in the labor market. Indicators of hiring labor shortages are really indicating that. There's slack there. So they look at that. They are of the view that you're unlikely to see an inflation spike going forward as long as there's slack in the economy. They want to see that slack be taken in. So what we really get to is we need to see an uptick in growth some point next year for the Bank of Canada to stop cutting. We expect a reasonably soft first half of 2025 in that sort of growth around 1%, perhaps a little bit higher. In that sort of a world, we think the Bank of Canada will be able to continue to ease the overnight rate in 25 basis point increments until June, regardless of what we see from the Federal Reserve next year.